Thanks a lot for that. Well, Deepak Shenoy, founder of Capitalmind, joins us on the show. Hi, Deepak. Afternoon. ONGC making a 52-week high, while the Nifty has corrected close to around 15% from the recent peak. How do you approach the stock from here on? Now we are suddenly hearing about $150 per barrel, $200 per barrel mark on. Would you look to get in, or is it a complete avoid?
Nigel, first of all, I think we are, in on our momentum portfolio because the stock is one of the few stocks making a new high now. But if you look at the structure of crude, will crude continue to be this high forever? And will the government not want to take these supernormal profits out of ONGC and benefit perhaps the common man by transferring some of those profits to the downstream, oil marketing companies? They've done this in the past where, since they're all government-owned companies, you just say instead of generating supernormal profits at ONGC level, let's reduce the losses at the refining, so the marketing level, so that people have to pay lesser prices for oil. So you should expect that ONGC will see such a commentary in the next few months, in fact, next few weeks. And in general, oil prices aren't rising forever. It's a supply problem that currently exists. And eventually, when the situation kind of evens out, I believe there will be a compromise that allows Russia to trade oil, especially with countries like India, which have been one of the larger. Russia has been one of the sources for India's oil. So given that, I expect crude prices to cool down. If you have negative government action, the long-term approach of buying ONGC is probably not a great idea. It's a good short-term momentum play, not a great long-term play, in my opinion.
Oh, that's a point well taken, Deepak. Good afternoon. What about Asian Paints, Deepak? That's now fallen 25%, right? It's very rarely that it falls this much. Even at the time of great falls that we've had, this has been more resilient stock. But are you looking to buy it here?
Actually, to be honest, Anuj, the stock itself is very expensive. Even though it has fallen 25%, it was valued at a PE ratio of, say, 80 times. It's one of the companies where, the free cash flows are great, but they're roughly able to only reinvest half their free cash flows. The rest comes out as dividends. So they're actually not, they're not able to reinvest those cash flows in any meaningful way. So I feel giving a 80 times earnings for this company is a little high. Now it's down to perhaps 60 times. I haven't seen the latest. But I think there are better plays in this space, including some of the banks or some of the smaller companies where, P ratios are much more normal now with a 25-30% fall compared to an Asian Paints. Short-term problems with Asian Paints are crude, of course, but I think, it could permanently see this kind of valuation of 40 or 50 times rather than the 80 times. So I'm not really interested in buying it at this point.
Just to go back to the oil point, Deepak, because it's got broader implications as well, right? For example, if the government does not sort of cut excise, basically takes on, uses excise as a safety valve and passes on the entire increase to the consumer, it's effectively a tax increase. So, this at a time when consumption is coming under some strain. What is your sense? Is that something which we are likely to do? Because the fact is that the LIC IPO has been kind of deferred. We don't know when that will come. The government will be in need of revenues as well, but this is also a sensitive issue. What do you think happens?
So I just took a look at the numbers. India has earned, the government has earned will earn probably 390,000 crores in excise revenues largely from crude. Their budget was 335,000 crores, and that is the same amount that is budgeted for next year. That means they've budgeted roughly 20% lesser than the actual collections of this year for next year. That means they have the ability to reduce taxes by 20%. They have the ability to take those ONGC profits that are supernormal and have them compensate oil marketing companies to keep a lower increase in price. They also have a lot of money right now. There's not much expenditure left, and the collections have been phenomenal. So their deficits are going to be lesser than even the revised estimates that came out in the budget. So I think there is a lot of room for the government to play this, especially because this is going to be short term. This is going to be probably 3 or 4 months at the max. And I think crude prices should start to correct rapidly after that, especially after the cessation of hostilities. And remember that this is a kind of a battle where you could have a compromise between the parties at any point in time. There's been an increase in changes from an economic sanction point of view. Russia has cut the tap of gas to Europe. This will spur action faster than later. And I think once that comes in, you should see a normalization of crude prices. This is not because of demand. This is because of lack of supply. And supply can be brought back over a period of 5 to 6 months. So if anything, the government will only do tax reduction for a short period of time, which I think they have a lot of room for. So I don't expect that the government will pass the full brunt to the end consumer. They will try to subsidize it at least for the short term, given this is a short term problem, at least in my view.
Okay, now let's address the top F&O loser, and it's JK Cement. It looks like the crowded paints market is going to get another player, and the market doesn't like that, Nigel.
Well, that's why they couldn't have picked a worse time. Crude oil prices spiking up, competition increasing as well. Sentiment on the paint industry is not great. And clearly, the street is not impressed by JK Cement's entry into the paint business through a wholly owned subsidiary. Over the weekend, the company approved an investment of up to 600 crores spread over the next 5 years odd. Brokerages, well, they don't view this favorably. As Phillip Capital, they have maintained a buy rating on the stock, but they've cut their target price big time, by close to around 18%, to around 3,500 rupees from around 4,100 rupees earlier. They have cut their multiple from around 17 to around 15 times on an FY24 EV upon EBITDA, as now they are viewing their foray as a bit of a sentiment dampener. Motilal, well, they have a neutral rating on the stock with the target price of around 2,925 rupees odd. They are valuing their white as well as their grey cement business now at around 14 and 13 times their FY24 EV upon EBITDA. Earlier, they were valuing it at around 15 to around 14 times odd. Considering now their entry into an unrelated business, that's why they've cut the multiple. They believe that the entry into this segment at such lower scale does not make business sense, especially at a time when competition, namely Grasim, is going ahead and putting the big money down. Kotak says it will not be easy for JK Cement to establish itself in the decorative paints business due to rising competition as well as inherent challenge, and add that they expect the company to scale up gradually at best. Well, so that's about JK Cement. Clearly, Street has not taken it well. Deepak, how would you view this one? JK Cement normally getting a higher multiple. They have that white cement business as well that helps them. Street normally was quite gung-ho on it. It's been a big value creator, but for the time being, there's a big dip. Would you look to buy into it at some point of time or stay away?
Staying away from cement in general, to be honest, because we think the sector is tremendously overvalued in general. There is not that much demand, I think, that powers much of the valuations over here. Plus, their move into, say, a paint business where there is a lot of very well-established competition, and it's going to take years and years for them to make a serious dent in that space. Might not really augur well for capital allocation. Having said that, it's execution that matters. So how they execute will show it. So if they start to show much better in terms of results going forward, then I might consider it. But right now, as a sector, we're avoiding cement. We're avoiding most of the commodity pack because any gains here is likely to be very short term in our view.
Okay, Deepak, thanks very much for that. So that's Deepak Shenoy with his thoughts on the market on a wide range of subjects, really. We'll take a very quick break here. We are back. We have Mithun Ashwath, Managing Partner at Kiva Advisors, joining us. When we return, we are back in just a bit.